Did you know that one of the most heavily debated EV stocks on the planet is, at this very moment, completely frozen in place? It's trapped inside a razor-thin 50-cent window. To the average retail investor scrolling their brokerage app, it looks totally dead. Flatlined, forgotten. But just beneath that quiet surface, a massive multi-million dollar financial tug-of-war is quietly playing out. And in the next 14 days, a stacked sequence of catalysts could rip this stock out of its cage and force a violent move. A move that most people watching will completely miss. Welcome to the NIO Paradox. Today, we're breaking down the exact 14-day catalyst timeline that could trigger the next massive swing in this stock. If this kind of deep dive breakdown is what you're here for, do me one quick favor and tap that like button and hit subscribe so you don't miss the follow-up when these catalysts actually land. It genuinely helps the channel more than you know. Now, to understand why a major breakout, or a brutal breakdown, could be right around the corner, we first have to establish exactly where the foundation is sitting right now. Right now, NIO is being actively pinned. Retail investors are frustrated. Volume feels completely drained. Everyone's parked on the sidelines waiting for a definitive signal to jump. The stock feels heavy, caught in a vice between rising sub-brand volume on one side and the very real threat of margin dilution on the other. But behind the scenes, a series of sequential, high-stakes binary events are rapidly approaching. And these are the kinds of events that historically don't let a stock stay quiet for long. So let's actually visualize what this paralysis looks like on the charts. NIO is currently trading right around $4.62, and it is quite literally trapped underneath a concrete ceiling of moving averages. It's facing immediate overhead resistance at $5.16 on the 50-day and $5.36 on the 200-day. The price action is undeniably heavy. After a recent second quarter delivery miss, the stock has been desperately searching for a structural floor, fighting to stay above its 52-week low of $3.34. To the untrained eye, this looks like a lost cause, a falling knife nobody wants to catch. But is that really the whole story here? Because while retail is panicking about the chart, the so-called smart money appears to be quietly positioning for something completely different. Look closely at this institutional positioning data. Hedge funds and institutions now collectively own 48.55% of NIO. But the absolute standout here? Renaissance Technologies. This is a legendary, almost mythical quant fund, one of the most successful in the history of Wall Street. And they just aggressively scooped up nearly 6 million shares. They now hold over 14.4 million shares, worth roughly $87 million. Now think about that. Why would one of the smartest funds on earth be loading up on a stock that retail investors have written off as dead? That's a serious vote of institutional conviction, landing right ahead of a critical turnaround window. And here's where it gets even more interesting. Short interest currently sits at 128.28 million shares, about 5.22% of the float. With a days to cover ratio of about 5.2 days, this isn't a monster short squeeze setup on its own. But make no mistake, there is absolutely enough short exposure sitting here to pour serious fuel on the fire if a positive catalyst hits. So how exactly are the derivative traders, the options guys, playing this precise setup right now? The options market is currently pinning this stock with almost surgical precision. Look at the July 31st expiry. There's a heavy put wall sitting at $4.50, with over 6,000 contracts acting like a magnetic floor beneath the price. And on the upside, there's massive open interest stacked on the $5 and the $5.50 calls, representing over 16,000 contracts combined. What does that tell us? Options traders are betting enormous money that NIO stays trapped inside this exact 50-cent window straight through the end of the month. But here's the question that should be running through your mind right now. What happens when that artificial boundary finally breaks? Because we are staring straight down the barrel of a major binary timeline, mark these dates on your calendar. First, we have the Federal Reserve policy meeting on July 28th and 29th. Then, the expiration of the 5-seater ES8 launch incentives on July 31st. But those are just the warm-ups. The real stock-moving shockwaves arrive on August 1st with the July delivery numbers. And then again on August 28th with the second quarter and first half earnings report. This is a stacked deck of catalysts, firing off one after another in rapid succession. Let's zoom in on that August 1st date, because it may be the single most critical immediate catalyst for this company's near-term direction. Back in June, NIO hit a massive 40,597 deliveries. That's a genuinely fantastic number. But here's the catch. To prove that number wasn't just a one-month sugar rush driven by temporary hype, the market absolutely needs to see July deliveries hold that 40,000 mark. Now, to be fair, Chinese weekly registration leaks mean some of this data may already be partially priced in by the time the official figure drops. But the official beat, or miss, on August 1st will still heavily dictate the short-term trend. So, what happens if they smash it 2 months in a row, and what happens if they don't? And if we dig a little deeper into these numbers, this relentless push for higher volume actually creates a terrifying new problem. Welcome to what I call the sub-brand cannibalization threat. In the first quarter, NIO's cheaper ONVO and Firefly brands made up roughly 30% of total deliveries. But in the second quarter, that number spiked all the way to 43.4%. And Wall Street is genuinely nervous about this. Here's why. They need to know whether this rapid, aggressive shift toward cheaper vehicles is quietly diluting NIO's gross profitability. In other words, are they selling more cars, but actually making less money on each one? Because if that's the case, all those impressive delivery headlines could be hiding a much uglier truth underneath. And this brings us to the ultimate fundamental tug of war that could decide NIO's fate in August. The second quarter delivery miss, 107,658 vehicles against a guidance floor of 110,000 is already known. It's baked in. It's fully priced into that $4.62 stock price. But the great unknown, the variable nobody is fully pinned down yet, is whether battery material cost efficiencies can effectively offset the lower average selling prices of these new sub-brand vehicles. The target everyone is watching? Protecting that baseline 18.8% vehicle margin. And here's the brutal bottom line. If those margins collapse, the stock very likely collapses right along with them. But that's only half the story. Because none of this matters if we ignore the massive hidden assets sitting almost completely off the radar. You see, NIO isn't purely a car company anymore. Before its IPO, NIO invested $23 million into a memory chip maker called CXMT, and that stock just debuted and surged an eye-watering 466%. That single move handed NIO an unpriced paper windfall of roughly 736 million yuan. And here's the wild part. The broader market appears to be almost completely ignoring this off-balance sheet tech investment. So the question naturally becomes, how long can Wall Street keep pretending this doesn't exist? And honestly, if you think that's interesting, wait until you see what NIO is quietly building in-house. NIO's AI chip spinoff called Genitech carries an internal valuation of $763 million, and NIO still retains a 63% stake in it. Their flagship chip, the NX9031, reportedly matches the raw computing power of 4 NVIDIA Orons. And it's not just being aimed at cars, it's being pushed beyond automotive into robotics platforms. In fact, Morgan Stanley literally described this unit as a, quote, visible call option for the stock. Think about what that means. There's an entire hidden layer of value here that most investors haven't even glanced at. Now, before we all get completely swept away in the AI hype train, there's a massive reality check we absolutely have to address because the core reality is brutal. NIO posted a net loss of 4.1 billion yuan in the first quarter. And there's a golden unwritten rule on Wall Street. When an EV maker is actively burning through cash, the market tends to ignore the flashy tech side quests entirely. NIO might genuinely be transforming into a vertically integrated AI and silicon platform of the future. But until the core auto business can prove it's capable of being consistently profitable, this stock is going to live and die by one thing: monthly car deliveries. So the tech story is exciting, sure, but is it enough to save the stock on its own? Probably not yet. So what is all of this actually worth? Let's walk through the 2 exact paths this stock could realistically take over the next month. Here is the best case scenario. Step 1. July deliveries print above 40,000, proving the momentum is genuinely real and sustainable. Step 2. Second quarter earnings confirm that battery efficiency successfully protected those all-important 18.8% margins. Step 3. The narrative finally shifts, and Wall Street slowly begins pricing in those massive Genitech and CXMT tech assets that it's been ignoring. If, and it's a real if, that entire sequence hits, NIO could break out past its moving average resistance at $5.16 and begin a structural march toward the analyst consensus target of $6.70. Imagine catching a setup like that before the crowd even wakes up to it. But as smart investors, we always have to protect our downside and respect the risks. So let's flip the coin. Here's the worst case scenario. Step 1. Volume slips, as consumer backlash over those surprise ONVO discounts causes July demand to fade. Step 2. Margin destruction. Second quarter earnings confirm that the cheaper cars cannibalize the premium lineup, gutting profitability. Step 3. Accelerating cash burn forces the market to completely ignore every one of those exciting tech assets. In that ugly scenario, the stock breaks down straight through its current support and starts flirting with a terrifying retest of its 52-week low at $3.34. This is exactly why you never bet the farm on a single outcome. And that brings us to the final, immediate playbook for how you should realistically expect this thing to trade. Over the next 14 days, expect NIO to stay heavily range-bound, most likely between $4.50 and $5. Right now, we're firmly in phase one, stasis. The options market has this stock locked in a holding pattern. But phase two, what I'm calling the August 1st collision, is where the real motion could ignite. If that delivery print hits 40,000, expect an immediate, aggressive test of the $5 psychological resistance level. The stock may look completely paralyzed today, but the catalyst roadmap ahead points towards serious volatility just around the corner. The setup is primed, the data is clear, and the smart money is already quietly waiting in position. Now, before we wrap this up, a quick and important financial disclaimer. Everything in this video is for educational and informational purposes only. I am not a licensed financial advisor, and nothing I've shared here should ever be taken as personal financial or investment advice. Stocks like NIO carry real significant risk, and you could lose money. So please, always do your own thorough research and consider speaking with a qualified financial professional before making any investment decision. With that said, I want to hear from you. Here's my question. If July deliveries actually come in above 40,000 and those margins hold, do you think NIO finally breaks that $5 ceiling, or does Wall Street ignore it and keep this stock pinned anyway? Drop your honest prediction in the comments below. I read every single one, and I love seeing where this community lands. If this breakdown brought you real value today, smash that like button and subscribe with notifications on, because I'll be tracking this exact catalyst timeline in real time as these dates hit. This is where you'll want to be when the story unfolds. Thanks so much for watching, and I'll see you in the next one.